Well, 2%, that is how much the U.S. economy grew in the third quarter, according to the first reading at least. It's a little bit better than expected or right on target, and it shows, though, that consumers are still hobbling their way through this recovery. Art Hogan, the chief market strategist for Jeffries, joins us from Boston. Art, thank you for being here. Appreciate it. Looking at these numbers, I mean, you guys have generally said we're not falling into a double-dip recession, but characterize the kind of growth you're expecting ahead, because, again, this is just the first reading. We may go down from here.
That's true. We've seen some revisions over the last 3 quarters that went down. We don't expect that this particular go-round, but the important thing here is what we're seeing right now is this is the 5th quarter of positive GDP growth rates. That's very important. What's more important, though, is we've got an outsized performance from the consumer, and we don't have a pickup in enterprise spend. I think the most important thing is, the inventories are continue to rebuild, but that's not sustainable. So, for GDP to move forward and continue to grow faster, we're going to need to see a transition from that inventory build to a real enterprise spend.
And also when you look at what this means for job creation, which is the number one focus, especially of the administration, is exports versus imports. We saw a decline in imports. Still, though, imports were up 17% in the quarter. Net exports were only up 5%. Until we have some closer balance there, the jobs won't come back.
That's exactly correct. I think you'll see the fourth quarter will benefit from the weaker dollar that we've seen, over the last 8 weeks on the exports, and I certainly think that's going to be a positive. So if there's one sort of glimmer of hope here moving forward, our exporters should certainly do better, as we've seen the dollar debase significantly, and probably continue to do so into the end of the year. So the fourth quarter probably does better on the export line than we did in the third quarter, but it's still sluggish across the board.
All right, and turning around to the equity markets, I mean, it seems like in past quarters, when we've had strong earnings throughout the year, the equity market has responded. We haven't seen that this earnings season as much, except for we've seen some luxury consumer brands on a tear. Take Coach earlier this week. Take Tiffany's. I mean, what's the divide here?
Yeah, it's interesting. You bring up a very, very good point. So, coming into this earnings reporting season, we actually saw a significant ramp from the beginning of September until the beginning of earnings season. The S&P 500 was up 12.5%. Of course, the dollar backed up about 9% in that same time frame, so you did have that inverse correlation. But as we look at the consumer discretionary spend, I think you point out something that's very important right now. We are seeing a pickup in consumer discretionary spend, but it's at the very high end, which means that there is a portion of the U.S. population that's actually getting back out and spending money. We saw that in back to school. We hope to see that reflected in holiday shopping season, but it's not the majority. It's not the sort of lower end, if you will, the dollar stores, the Walmarts, and the Targets. It's as you mentioned, the Abercrombie Fitches, the Coaches, and the Tiffany's that are actually seeing a pickup in revenue, and they had very easy comps on a year basis as well.
There's also the theory that the market might like this GDP report because what it means ahead of next week's Fed meeting is that the Fed most certainly has to take possibly even more action than they were planning on before. Is that your read, Art?
Well, it's interesting. So the Fed has been very clear over the last couple of days. I think they used a couple of their favorite mouthpieces to sort of get the message out. Yeah, exactly. So you've got the Fed trying to guide us down from the ultra extreme expectations of $1 trillion worth of quantitative easing down to something closer to a manageable sort of think about $200 to $500 billion worth of quantitative easing. I think the gradual approach should probably make sense. I think we should expect to hear, $100 to $125 billion a meeting for the next 4 meetings, gets you to $500 billion over a period of 6 months, and then we'll see where we go from there.
Does that do what's needed, Art? I mean, I keep reading and talking to experts that say we need $2 to $4 trillion to bring us out of this. So you see a small move by the Fed. Isn't it too little? Could it be, as many have criticized the stimulus for being too little, not fast enough?
I think you have to look at it in a couple different ways, and I've certainly heard those arguments. But take the counterintuitive approach to this and say if the Fed looks at current economic conditions and doesn't see a need for as an aggressive second round of stimulus at this juncture, and also steps back and says, listen, we already have $1 trillion in excess reserves sitting in money center banks that's not being put to use, whether it's because of lack of demand for loans or banks' willingness to lend still being on the 2008-2009 thought process. So I clearly think that what we need to do is actually fix the conduit, unclog the system such that these excess reserves are actually being lent out. Until we get sort of final rules on financial services regulation, we're not going to see that conduit come unplugged, whether we've got $1 trillion or $2 trillion in excess reserves. What we need to do is fix the transmission system. That's not working right now, so small and medium businesses aren't getting loans.
And finally, outside next week of the Fed meeting, what else are you looking at that you don't think is getting enough attention but is critical to this market?
Well, three things next week. So obviously the Fed meeting, and we've heard plenty of talk about QE2. We'll see the results of that November 3rd. Remember, we have midterm elections coming up, and we get those results as well.
But the market's pricing that in. I think they were pricing in Republicans taking over the House, at least.
Well, they're certainly pricing in. I think that's what's been baked into the cake. The Senate's too close to call, but probably doesn't flip. Is this good gridlock or bad gridlock? Good gridlock meaning, we've got a split here, so the Republicans can actually push the agenda more to the center, have more moderation on both fiscal and monetary policy and new spending plans. I think that's good gridlock. Bad gridlock is if we're frozen up, we don't move on anything, we don't sort of roll forward tax cuts and things of that nature, we don't sort of bring cap and trade back up and some of the other initiatives that should come up in the next session of Congress. So as we look at this, I think the election results may well be baked in. The Senate's a wild card on that, but it should be an exciting week. And don't forget, at the end of the week, we get a fresh reading on the payroll numbers, so we'll have a fresh view of what the unemployment rate looks like.
Big week ahead. We'll see. We'll rest this weekend and see what's to come. All right, thank you.